Welcome everyone. This is our second series session for our Plan Giving speaker series with the Bonneville Hospital Foundation. Today we will be talking about plan giving using life insurance. My name is Bethany Matovich. I'm the manager of major gifts and plan giving for the Bonneville Hospital Foundation. We are very excited today to have Beata Rodzoch and Sanjana Bhatia of Sun Life with us to walk us through life insurance and our estates. Beata is a financial planner with Sun Life. She's worked in the financial industry for over 12 years, helping her clients achieve lifetime financial security. With a vast knowledge base, strong integrity, and years of experience with loyal clients, she specializes in helping individuals and small businesses work towards pursuing their financial goals. Recognizing that each client has individual needs, Beata dedicates herself to understanding and appreciating each client's situation before making recommendations. She believes in educating clients and works diligently to help develop achievable goals. Lifelong vegetarian and a strong advocate for animal welfare, Beata lives in Oshawa with her husband and 3 fur babies. We also have Sanjana Bhatia today with us. She's the Director of Tax and Insurance Planning with Sun Life. She supports the distribution partners and advisors to deliver cutting-edge tax expertise, training, and thought leadership in all areas related to insurance taxation and tax and estate planning. Prior to joining Sun Life, Sanjana was a tax lawyer in a national law firm for 14 years. She has also provided tax, trust, and estate planning consulting at a major financial institution. Sanjana started her career at the Department of Justice, where she argued cases before the Tax Court of Canada, Ontario Superior Court, and the Federal Court of Appeal. Sanjana also has a master's degree in taxation from Osgoode Law School. We are excited to have them both with us this morning. Beata, the floor is yours.
All right, good morning, everyone. Thank you so much for having us. Really appreciate the time to be able to speak to life insurance so early in the morning. I am a local advisor. I'm out in the Oshawa area. So we're not here to replace your current advisor, but if you like any information, if you're too shy to speak online, please reach out to Bethany. She does have my information. You can call me, you can text me, you can email me. We can help you through this process if it's something that you're interested in. When Bethany first approached me about speaking, I was actually absolutely terrified because I am terrified of public speaking. So I have the best person with me today. So Sanjana is one of our directors of tax and estate planning. And thank you so much, Sanjana, for the foundation for allowing us to speak. So thank you.
Okay, so today I'm going to discuss planned giving. It's also called charitable giving. And Canada has one of the most generous charitable tax credit regimes, probably one of the best in the world, but it's probably one of the most underutilized areas of tax and estate planning. For example, it's more than just collecting your charitable tax receipts, $50, $20, $100, whatever you've collected over the course of the year, and then claiming them on your income tax return that's due on April 30th. For example, there's a lot of opportunity for planned giving with life insurance that you may not have thought of. Today, I will show you 5 life insurance opportunities where clients can receive a tax credit, reducing their tax payable by up to 54%, depending on what province you're in and the amount of the donation, and where clients can feel good about giving to charities of their choice. So starting with a disclaimer, I will have a lot of examples throughout this presentation, but they should be confirmed with a legal or tax professional to make sure that your facts match the examples. So while the examples are solid, it's always good to receive independent tax advisor advice. I will have 3 questions throughout this presentation, so it'd be great if you could participate in the Zoom poll. So the agenda for today is the who, what, when, and why of donors. I'll be giving you an overview of the charitable tax credit rules in Canada, 5 life insurance opportunities with examples, and concluding with Sun Life resources that we have on our website that are available for more information. So the opportunity. There's a recent survey that was done where 91% of advisors report having giving conversations with their clients. Yet clients reported that only 13% had meaningful conversations with their advisors. So this gap shows that there's opportunity for planned giving, that perhaps clients need more education about the planned giving opportunities. And that's what I'm here to help with you with today. Also, the power of donations. If every Canadian who made over $100,000 a year or more in income gave 1% of their income, this would increase our resources to charities in Canada by $1.6 billion. So that would be huge in helping with various charitable activities. Now, clients have various beneficiaries to choose from. Of course, they want to give to friends and family, to perhaps a charity of their choice. And the last place they want to leave their tax dollars to is the Canada Revenue Agency. But who gets how much and when depends on us and the result of the client's estate plan. And that's what we can help you with today. So where do we start? Well, we can begin planned giving by reflecting on our clients' interests, concerns, and values, and where they would like to lend a hand in legacy. And there's lots of choices as are listed on this slide. Currently, there's over 86,000 registered charities with the CRA. And if there's a charity that you're not sure if it's registered or not, you can go to the Canada Revenue Agency website, go to the charitable section, and you can type in the name of the charity, and it'll tell you whether or not it's registered. So now going on to the charitable tax credit regime. So Canada has a two-tier credit regime. It's actually three-tier, but the first tier is the federal tax credit, and then there's provincial tax credits that apply on top of that, and they vary depending on province to province, the percentages. The federal percentage is 15% of gifts up to $200. In excess of $200, it's 29%. And then you'll have the provincial tax credits on top. There's also another enhanced tax credit for those that are in the highest tax bracket and who make a donation over $200. So this is a non-refundable tax credit, and it applies against tax that's owing. So if tax isn't owing, then those credits will be can't be used. But you can carry forward tax credits, as I'm going to get into in a second. And corporations receive deductions based on their corporate tax rate and not tax credits like individuals do. But this presentation is going to focus on individuals. So let's look at an example of how the charitable tax credit would work. Let's assume we have Daniela, who lives in Ontario, and she's donated $1,000 to registered charities in 2021. Her federal tax credit would be $262 when you take the 15% up to 200, 29%. And then the provincial tax credit, it's 5.05% up to $200 in Ontario. And then in excess of $200, it's 11.16%. So her total provincial tax credit is charitable tax credit is $361.38. But as I mentioned, if Daniela was in the highest tax bracket, this could actually increase to up to 54% in Ontario. So the maximum tax charitable tax credit that someone can claim in a year is 75% of gifts made during their lifetime. And this 75% of net income. And this increases to 100% of net income in the donor's year of death. And it's also 100% of net income for certain gifts. And these certain gifts include gifts of environmentally sensitive land and Canadian cultural property. In Quebec, however, for the 2016 taxation years and following, this limit is eliminated for individuals. Now, there's also no capital gains tax on gifts of publicly listed securities and non-registered seg fund contracts. And this is sometimes an overlooked rule that came about in 2016. For example, there was a situation that I heard about where someone had $2.5 million worth, the fair market value of publicly listed securities, but they wanted to donate the cash from the securities. They sold the securities, paid tax on it, which I don't know what the adjusted cost base would have been on those shares, but assuming it was nominal, that would have been resulting in over $600,000 in tax. So they sold the 2.5 million worth of securities, paid the $600,000 in tax, and then donated the cash to the charity. It would have been way more tax efficient to donate the publicly listed securities directly to the charity, and that they would have saved on the capital gains tax. So I cringed when I heard that. So it's something that to keep in mind. I'm also going to be discussing a strategy where you can give a life insurance policy along with publicly listed securities and how that results in a win-win situation for the donor. So when a gift exceeds year's maximum, you've claimed your max up to 75% of your net income, you can carry forward up to 5 years those charitable gifts. And in your year of death, you can carry them back to your terminal tax return, again, up to 100% of the net income. And it would be up to the executor to file an amended return for the 1 year carryback. So let's continue with our example with Daniela. She wants to give $120,000 during her lifetime to her favorite charity in 2016. We're going to assume that her net income is $80,000 in all years. So the maximum that she can contribute is 75% of that, which is $60,000. And she makes no other charitable gifts. She has the choice of structuring that donation. She can choose to give 1/6 of that donation over a 6-year period of $20,000, and that would reduce her tax bill for 6 years. So assuming that she gave $20,000 each year from 2016 to 2021, her total charitable tax credit would, for all of those years, be just over $47,000. She could also decide to give $50,000 each year in 2019 and 2020 and use the excess in 2021. So again, her total gift is $120,000 over those 3 years. Her total charitable tax credit would be just over $48,000. Now let's assume that Daniela wants to make the gift through her will. So she leaves $120,000 to her favorite charity in her will. She passes away in 2021. Again, we're going to assume that her net income in her year of death was $80,000. Her maximum amount that she can claim in 2021 in her year of death is 100% of the net income, which was $80,000. So her total charitable tax credit would be $32,000. The remaining $40,000 can be carried back to her 2020 income tax return, and that would result in a total charitable tax credit of over $16,000 for a total charitable tax credit for both years being over $48,000. So now I'm going to get into the life insurance opportunities. The first one is to donate a brand new policy. The second one is to donate an existing policy. The third one is to donate the death benefit proceeds. The fourth one is to donate life insurance as a wealth replacement strategy. And the last one is to donate the RSP or RIF that a client has and using a life insurance policy to replace the value of that RSP or RIF. So donating a new policy, in this situation, the charity would eventually be the owner and the beneficiary of the policy. So the donor during their lifetime would purchase a life insurance policy and then would pay the first year minimum premium on that policy, and then would transfer that policy or give the policy to the charity. On giving the policy to the charity would issue a donation tax receipt for the value of the policy. Now, if there's an income tax rule in the Income Tax Act that if you give the policy within 3 years, then the fair market value, the charitable tax receipt is going to have to be the lesser of the fair market value of the policy or the adjusted cost basis of the policy, which will probably be very low in the first year. there's also an income tax rule that says if the policy is donated within a 10-year period and the intention when the donor bought the policy was to donate the policy within that 10 years, then again, the charity would issue a charitable tax receipt for the lesser of the policy's fair market value or ACV. But if these 3 and 10-year rules don't apply, then the charity can issue a charitable tax receipt for the full fair market value of the policy. And the fair market value of the policy would have to be determined by an actuary. And the various factors that an actuary would consider are set out in CRA Information Circular 89.3, and they include the health of the life insured, the policy's cash value, the loan value, the face value, any indemnity factors, and the replacement value of the policy. So, and then after transferring the policy to the charity, the donor would continue to pay the premiums and would receive a charitable tax credit for those premiums that are paid every year. So let's look at an example of John Smith, who purchases a policy when he's 50. He's purchases it for $500,000. It's the premiums payable over a 10-year period with an annual premium of just over $20,000. So he would receive a charitable tax credit each year on that premium, just over $8,200. At death, the life insurance policy company would pay the death benefit to the charity on a tax-free basis, but there would be no donation receipt to the donor for the death benefit because they've already received a charitable tax credit for the premiums that they've paid. So now we're ready for a poll question. So I'll get Bethany to launch the poll, the Zoom poll. Okay, so the first question is, when donating a new policy, the client will receive, or the donor will receive, a charitable tax credit for which of the following? The annual premiums, the value of the policy and the transfer, A and B, C, or the death benefit. Can you see the poll, by the way? Can you see the poll? Yes, okay.
Yes, yes.
So, okay, great. So I'll just get you to vote.
We're seeing the polls, but we're seeing all 3 polls.
Oh, so you're not seeing the voting button, right? Okay. Here, you know what? Okay.
Just want to, if we're able to just give an answer on the first question, and then I can relaunch for each question. It does look like C is coming through as the winner, Sanjana.
Okay, C is the correct answer. So you guys are on the ball for this early 8:30 morning. That's awesome. That's great. That is the correct answer. So you will receive, when donating a new policy, the donor will receive a charitable tax credit for the annual premiums and the value of the policy and the transfer. Very well done. Okay, so I'm going to move on to the next slide. Okay, opportunity number 2 is very similar to opportunity number 1, but the client, perhaps they've had a policy for a while. The beneficiary, the intended beneficiary, has since passed away. So now they have this policy. They don't know what to do with it. Instead of having the policy lapse, they can give it to a charity. And again, the charity would be the owner and the beneficiary of the policy. So in the same situation as opportunity number 1, the donor has a policy, probably had it maybe for a long time, and then donates it to the charity. So again, the charity would issue a donation tax receipt for the fair market value of the policy or the ACV of the policy. And if they've had the policy for a while, then the donor would have to report a gain, probably as if they've had the policy for a while, there's probably cash surrender value that's accumulated within that policy. So they'd have to report a gain, and the gain is calculated as the cash surrender value of the policy minus the adjusted cost basis of the policy. And the insurance company would issue a T5 for that amount. And that would be reported not as a capital gain, but as regular income. And then the donor would continue to pay the premiums and would receive a charitable tax credit on those premiums every year. So let's take an example of Mary Jones, who purchased a policy when she was 50, and she named her husband as the beneficiary of the policy. She it was $250,000, the policy, and the premiums were to be paid over 20 years. So she's paid 15 years on those premiums on that policy. Her husband since passed away, so now she's 65 and wishes to donate the policy. So she has 5 years left of premiums to pay. So she would receive a charitable tax credit of just over $2,200 for each of those 5 years. It's likely that those 3 and 10 years rules under the Income Tax Act would not apply in her case because she didn't purchase the policy with the intention of donating it, and the 3-year rule, the 3 years has gone by. So she would probably receive an additional charitable tax credit on the full fair market value of the policy. Again, the fair market value of the policy would have to be determined by an independent actuary. So at death, the life insurance company would pay the death benefit to the charity. But again, there would be no tax relief to the donor's estate for the death benefit because they've already received a charitable tax credit for the premiums that they've paid every year. So poll number question 2 is when donating a new policy, when donating existing policy, the client will receive a charitable tax credit for A, the annual premiums, the value of the policy on transfer, A and B, or the death benefit. So I'll just give you a second to vote. And maybe Bethany, you can tell me what the votes are coming in as.
I see a couple coming in here on question 2, so I'll just give it one more second and then
Okay.
C is taking the lead on this one again.
Okay, so the answer is C. I've kept it simple this morning. Thank you very much. Yeah, that is the correct answer. So well done. Yeah, it's very similar to number 1. So, okay, now the bonus opportunity I want to discuss is with publicly listed securities. So let's continue with our example of Mary Jones. Let's assume that she had shares that were worth 50,000. She also wants to donate those. If she donates those shares directly to the charity, she would save on the capital gains tax, which would be calculated around $10,000. That's assuming a 50% income tax rate on Mary Jones. So that would be one advantage. And she would also receive a charitable tax credit on the $50,000 of those shares. And now the charity who receives, so she sees an immediate gift during her lifetime on the gift of the shares. Now the charity can either sell the securities and use the proceeds to pay for any future premiums, or use the dividends from the securities to pay for those premiums. Or Mary Jones can continue to pay the premiums, and then she would receive a charitable tax credit on each of those premiums. Now, this is a win-win strategy because the donor sees the immediate value of their gift of the shares and receives charitable tax credit on those shares, and that eliminates the capital gains tax. And then there's also she'll receive a donation tax credit for the value of the policy as well. So there's a lot of advantages to this method. Now, opportunity number 3 is donating a lump sum to the charity as death benefit proceeds. In this case, the donor would remain the owner of the policy, and the charity would be named directly as the beneficiary. The donor could also leave an amount in their will up to the amount of the death benefit proceeds, and I'm going to show you that method as well. So the donor would purchase a policy and pay for the premiums on the policy, and they would name the charity of their choice. They could also name a donor advised fund, and the advantage of that is that the the donor advised fund would donate to the various charities that the donor prefers. So, but there would be no donation receipt for the premiums. Now, at death, the death benefit is paid to the charity and would issue the donor's estate or a charitable tax receipt for the death benefit amount. So let's say $500,000 was left to the charity. In Ontario, that would result in a total charitable tax credit of just over $200,000. Now, the estate would have to be what's called a GRE, or a graduated rate estate. And there's certain requirements that have to be followed in order for the estate to be a graduated rate estate. And then if the estate is a graduated rate estate, then there's the flexible use of the tax credit where they can use all of it in the year of death, or carry it back 1 year, or carry it forward up to 5 years. The advantage of naming the charity directly as the beneficiary of the life insurance proceeds is that there will be no probate fees or estate administration tax, as it's called in Ontario, which on a $500,000 death benefit would be around $6,700. There would also, the death benefit would not be subject to any creditor claims of the estate or any estate litigation claims. Now, the other way that the death benefit could be structured is that the donor could set out in their will that they want to leave an amount equal to the death benefit proceeds. And the rules were changed in 2016 so that the charity could issue a donation receipt for the death benefit amount. But the disadvantage of this method is that the death benefit proceeds would be subject to any probate fees and estate and creditor claims. So the preferred method is to leave the death benefit proceeds directly to the charity. So poll number 3, and it's our last poll. I'll get Bethany to launch it. Okay, and the question is, when donating the death benefit proceeds, who is the owner and the beneficiary of the policy? A, the charity is the owner and beneficiary. B, the client's the owner and the beneficiary. Or C, the client's the owner and the charity is the beneficiary.
Got a few answers coming in. I'll just give it a couple more seconds here to see. And again, we have the majority on C.
Yeah, so that is the correct answer. So good job. That was the last poll question, and well done on that. So now the opportunity number 4 is giving a asset during the lifetime, and then the donor would purchase a life insurance policy to replace the value of that asset. And any of the assets that can be given. I already discussed the power of giving publicly listed securities where no capital gains tax will apply if the securities or the shares are donated directly to the charity. And that also, there's also no capital gains tax on donating non-registered sec fund contracts. You can also donate real estate where generally 50% of the capital gains will be taxed, except for Canadian cultural property and ecologically sensitive land. And I'll get into the advantages of that. You could also donate jewelry, artwork, cash, T-bills, or anything else. And the tax savings used on receiving the charitable tax credit of donating those assets can be used to purchase a life insurance policy. The tax advantage is that the client will receive, or the donor will receive, a tax receipt on the donation of the asset. The charity receives immediate support that the donor can see during their lifetime. The beneficiaries will receive the life insurance proceeds on a tax-free basis. And by naming beneficiaries directly of the life insurance policy, the proceeds will not be subject to probate or creditor claims. But the clients will have, the advisors have to be aware of the tax shelter rules under the Income Tax Act. Now, the advantages of giving certified cultural property and ecologically sensitive land is generally the capital gains will not be taxable. And also the annual donation is increased to up to 100% of net income. And also with donating ecologically sensitive land, the carry forward period is increased from 5 years to 10 years of carrying forward any excess donations. Now, the things to note on all gifts is that the life insurance premiums and the death benefit are not eligible for charitable donation tax receipt. Also keep in mind that it's probably, if you're giving, like for an example, assets that's increasing in value, to purchase a policy with an increasing death benefit. For example, this was topical last year in the news. For example, there was a woman in Vancouver, or in her will, in her 2003 will, she left her principal residence, or her home, to the BC Society of Prevention for Cruelty to Animals. She passed away in 2020, and that home in Vancouver rose to over $1.5 million at death. And that 1.5 million home went to the charity, and the heirs were not impressed with this. So they brought litigation to receive some of the value of that home. So had she had a life insurance policy that had an increasing death benefit that kept up with the value of the home, then maybe that wouldn't have been an issue, because that would have resulted in estate equalization, where the heirs could have received the $1.5 million in the life insurance proceeds, and the charity could have received the home. So that's something to keep in mind. There was a lot of litigation happening on this issue, and that would apply in Toronto or anywhere where in the GTA where property is increasing in value. Now that may go down, that trend, with the increase in interest rates, but property values are still high. So now the other spin is on the wealth replacement strategy is to give an RSP or RIF. So the way that would work, say that the donor has a $200,000 RIF or RSP, they can name the charity of their choice as a beneficiary of that, and then purchase a life insurance policy that's equal to the value of the RIF, and then naming the friends and family as the beneficiaries of that policy. Now, the tax advantages is that the $200,000 will be included in the client's income in their year of when they die, but the estate will also receive a donation tax credit that could offset the tax on the RSP or RIF income. And the friends and family would receive the life insurance proceeds on a tax-free basis, and those life insurance proceeds would not be subject to any creditor or estate litigation claims, because the beneficiary has been named directly. Now, here is a summary of the opportunities number 1 to 5, which is good to refer to. It just summarizes what the opportunity is, who would be the owner and who would be the beneficiary, the taxpayers or the donor's tax benefit during their lifetime, and the tax benefit at death. So I really like this slide because it's a good little summary of the opportunities that I talked about. Now, we have resources on our Sun Life website to help you. We have a plan giving guide for advisors and things that advisors should look for, a guide for clients that goes through all of these strategies, as well as an advisor tool where you can put in the amount of the donation, and it'll estimate the charitable tax credit for you. And now I'll take any questions. Okay.
Anybody have any questions for Sanjana? Sanjana, I have a question for you. So is it possible to name multiple charities when we're speaking of life insurance, or does it have to just be one? Like, would you have to have separate life insurance policies if you wanted to leave it to separate charities, or?
Oh, no, you can have multiple charities. Yeah. Or use a donor advised fund as well, where if the donor's passed away, then the executor would have to choose which charity the funds would go to. But yeah, definitely you can name multiple charities as the beneficiary on a life insurance policy.
I won't introduce myself. I think most people know me. I'd like to thank Sanjana for a great presentation. The use of life insurance is a great vehicle for helping donors enhance their donation to their chosen charity. And as you can see, there is several options available for doing that. A planned gift is usually a substantial gift, a once in a lifetime gift made by the donor with lots of forethought. So that's where sort of the name planned giving comes from. There is, as Sanjana indicated, a lot of potential significant tax benefits also that are involved with a planned gift. I refer people to our website. Is the website on there? There we go. If they would like more information about our planned giving program or other programs that the foundation has. One other thing I should mention, our planned giving program is relatively new. We're basically just launching it. And the objective of the program is to provide donors, those donors who wish to leave a lasting legacy, that's not only going to benefit healthcare currently in our community, but will continue to benefit healthcare well into the future. So again, I'd like to thank Sanjana for a great presentation, and thank you, Beata, and hope everybody has a great day. Thanks very much.